Hey traders, this is Ron Hayden at Market Tamer. Happy Sunday. Hope you're having a fantastic weekend. As always, nothing in this presentation shall constitute a recommendation to buy or sell any security. Trading stocks and options involves risk, and specific financial issues should always be addressed with your financial advisor. Here is the Dow ETF, the diamonds, the DIA. We finished the week in a bullish posture, basically almost flat on the week, but we're still above moving averages, so bulls get the edge. Target remains the October 3rd highs. Take a look at the SPY, zoom in, same thing, flirting with the previous highs, target up there, which is right around October 3rd, 290, $10 on the SPY is 100 S&P points. The Qs, flirting with a previous high, again, we're above all moving averages, so where is the target? Pretty much the highs, back on October 3rd, right around 186 area. So on the dailies, everything remains bullish. If the bears would come in a little bit, maybe some selling finally takes place because it's been a really nice, consistent ride higher after the Christmas Eve low, it would be the red line. Whether it's the Qs, the SPY, the diamonds, the Russell, doesn't matter. The red line is the 20-day exponential moving average. I would consider that for a trailing stop. That's 20 days worth of data or a month of trading. We get below that red line, then we go down to another moving averages, or we go down to previous lows. So below the red line, the bulls would lose the shorter term edge. They would go neutral to even having the bears with a slight edge. Right now, I'm much more concerned with, and looking at the Qs, the red line versus the purple line. We've already spent some time above it. The red line acted as support before. And then if I go back to something like the DIA, zoom in here, you can see here's the red line. We get below there, bulls lose their edge. Now we go down to purple, orange, and frankly, would be down here for support. But again, not saying we're going to get there. The bulls are doing just fine. All right, how about bonds, TLT? Here's a 2-year view. We're in the middle of this massive trading range. You know, back at the beginning of the month of January, on the 3rd, we got back up and started testing the 123, 124 area. Down, we try to rally back up to 122, we roll over. So this puts us in a huge trading range again. Downside targets would be, the 200-day in purple. We could go there, that's an institutional moving average, but then we'd have to go to a gap fill at 115 and then all the way down here. If I had to pick a trade idea in a virtual trading account, I'd frankly go with a bear call somewhere up at 122, 123. For my short call, if there was any premium, maybe going out 1 to 2 months, because the way this is played out, lots of back and forth, and this is the area that's trouble getting through. So again, virtual trade idea, we could do something like that on paper with fake money, because as of right now, the momentum is down. See if that can continue. All right, how about gold and silver? Now, I have exited my bullish position on gold. It was a nice ride while it lasted. Remember, I told you guys, watch December from a seasonality perspective. Watch January, and you can see what happened. At the end of December, we busted above the 200-day. Here's the beginning of January. There's the pullback to the 20-day. There's the thrust. Pull back to the 20-day in red. There's the thrust. And then if you look, remember how I say I like those 20-day EMAs as a trailing stop? On 228, we closed below. Next day, we gap lower, finish lower. Now we're even below the 50-day. So for me, any new gold trades, they're just not there. This was a specific window of time, the December, January, February time period. It's now over. Like I said, nice ride while it lasted. And now, frankly, I'm going to wait till January again next year or December to keep an eye on it, unless we get some kind of fundamental change in the market. It doesn't mean gold's a bad idea or something to trade throughout the year, but if I'm using seasonality, December, January timeframe is when it turns into a rock star. You go back looking 6 straight years, it's a winner, winner, chicken dinner every time. All right, now moving on to the gold miners. Let's take a look here. Let's go GDX. Because gold is broken below the 50-day. How about the gold miners? Well, they are above their 50-day, but they're below the 20-day. Last time we got to the 50-day in orange was January, and then it resulted in about a 15% run, 10% run. If I was trading GDX bullish and it got below the red, this orange line, I could not trade it any more bullish, because now you've lost the 20-day period, you'd be losing the 50-day period too. At some point, you just have to walk away. Now, I don't have a position in GDX, but if I did, that would be the final line in the sand, because it also sort of acted as support here. If I go to GDXJ and I zoom in, similar story, it's almost at its 50-day. Again, the 20-day was fractured back on the 28th. If I go to SLV, we zoom in. It gapped below the 50-day and closed below the 200-day in purple. 50 days orange, 200 days purple, and we took out a previous low. I would say gap fills a target around $13.90, another 30 cents or so lower. Silver was never, outperforming gold to the upside, which if you believe in the gold silver trading patterns, silver should be supportive of gold. It should be going up with it, maybe even outperforming it, which looks like great strength, or maybe even some really big volume. It was never there, and I highlighted that in some of these videos. And now silver is, I would say, outperforming to the downside. It blew through moving averages and even took out a previous low already. If you go to the silver miners, they closed at 26.01. The 50-day was 26.02, so you're a penny above it. There's also the 200-day in purple. You can call it confluence right there around 26, but you're already below the previous low. I mean, the last thing I would hold on to would be that 200-day and the 50-day at 26. We get basically 2-3 cents below where we closed on Friday. It's all the bullish trend is over on the daily, and then the target becomes down here. So across the board, the metals are now weak. I would consider it an end of the seasonally bullish period. So hopefully you find that helpful. So I know I talked about it as we got into December and January. Now here's something interesting. This is CRSP, CRISPR Therapeutics. Do not trade the stock, never have, but I was just searching around for different movers and this one popped up. And I see a stock that went from 65, down into the 20s, lost a lot of its value. And then I see some of this. Then I saw the earnings pop on February 25th. If I zoom in closer, there's an earnings pop, huge volume in comparison. Immediately gives it all back. But look, not all, but pretty much of that move, right? But look at the volume. It collapsed. Then we have another down day on Thursday, collapsed. Then we get a big up day again, and it closed above the earnings high. To me, this is very strong price action. I would consider a 20-day EMA in red as an intraday trailing stop. The target is the 200-day at 45. It doesn't look that far, but that's 10%. We get above the 200-day, frankly, up into the low 50s would be the target. Maybe in here just under 50, 49, but all this over here would now be the upside technical target. I think that's a really nice potential move. Plus, look at this, left shoulder, head, right shoulder, depending how you want to draw the neckline, it could be a little crooked or you can just do a horizontal one right around 40. We're pretty much meeting that criteria. So this one looks interesting. Again, paper trade, fake money, that way there's no risk, and you can see how trailing stops can work. But I love this pattern. Thrust up, light volume pullback, and then another thrust, which is ticker symbol BE. You can see how we put a bottom in here at 10. I talked about it breaking out. It's been a long drive down, 35 to 10, right? We're starting to see little pops in volume as we get over the 50-day, more buyers than sellers. The price is finishing higher. And now we just had another thrust on Friday. Immediate target 1750, about $1.20 higher, but then gap fill 2250, just like I said in the other video, and then way back up here. Those are all upside technical targets, and I would use the red line as a trailing stop. Now, I had a question on Tesla. If there's any change here in my outlook. Here's a 2-year view of Tesla. It almost looks like TLT to a degree. It's just a massive trading range. Musk, someone needs to take away his Twitter account. The dude just is not good for business in that sense. Resistance up here, support down here. We're in the middle. There is no change. This is a massive $130 trading range, 250 to 380. Until that breaks, I would probably be drilling down on maybe hourly charts, intraday charts, something, because it gets down here, it seems to bounce. Gets up here, it seems to sell off. Right now, we're in the middle. I do not like those reward to risk ratios. Taking a look at Facebook. Zooming in, moves higher, slow pullback to the 20-day, tries to bounce, can't get above the 200-day. If I zoom in further, we're playing a little bit of like ping pong here. 20-day EMA to the downside, 200-day to the upside, sort of plays out with the gap up. We need this break. This could still be considered a bull flag, flagpole, flag. I could even say flagpole, flag. Point is, we need to break above the 200-day or below the 20-day. So I'll keep an eye on this one. That's really it. I'm back this week in town, so I'll have videos out tomorrow and the rest of the week. I wish you guys a great trading week ahead, and I'll see you in the next video. Take care.